Hi, thanks for joining us. So today we're going to talk about the application form in payroll expenses. So today we're just going to briefly touch on the PPP loan application, dig in a little bit to calculating the payroll cost, and then unpack this whole idle loan and PPP thing, kind of talk about how they go together and what might be some of the misses that we had on the SBA and the Treasury side of things. So the application is out there. We're actually out on version 3, which hard to keep track of because that happened over 48 hours, but we've honed in on a application that has been accepted by several SBA 7A lenders. And in that application, as we've talked about in the past, one of the most important things is going to be that payroll cost calculation. So I wanted to walk through an example of that calculation so that you're able to move forward with confidence in terms of the data that you're collecting and a number that you expect to see. So here you can see we've outlined again that A through G, and we're going to start to cut some of this apart and talk about how it's going to come together. So first and foremost, what is the time period under consideration? Well, in the Act, payroll costs incurred during the 1-year period before the date on which the loan is made. Many of us interpreted that to be a rolling average. And as that average rolls forward, it could serve to diminish the maximum amount that we can get as a lot of our practices are shuttered. So it was great to see that in the guidance of it in clarifying language, payroll costs for the preceding calendar year. Not only does that give us a full year of actual operations, but it makes the data collection pretty easy because they're going to be a variety of year-end reports. The first year-end report that we want to make sure we dig out and we compile is going to be based off of our payroll company's reporting. So we can go to our payroll system, we can grab the 2019 year-end, and we'll pretty much satisfy kind of A through D in terms of what are those cost categories that go to payroll costs. So salary, wages, commission, payment of tips or equivalent, payment of vacation, parental leave, and an allowance for dismissal or separation should be captured in that payroll report. The next piece that's going to give us significant information is going to be our pension study, our finalized pension study. Now, in the red over here, I made sure to identify that annual compensation and employee deferral. That's actually going to be inclusive. The deferral is part of that compensation, but our most accurate information there still is going to be our payroll report. For the information here in green, the final 3% safe harbor and the profit sharing numbers that we did for the year, those are solid numbers. In the cash balance plan, that actually is an accrual of benefits because it identifies payment of any retirement benefit. That payment piece of it would lead me to conclude that if you overfunded your cash balance plan, you can still run that proportionate overpayment across your employee base to ensure that we're maximizing the payroll costs that we use for this calculation. Now there's 2 items that I don't have specific reporting examples for, and quite frankly it's because they're going to be based off of the individual decision by our practice owners in terms of what do they want to do for healthcare reimbursement, or insurance, and on that state and that local tax assessed. So whomever you're using for employee healthcare benefits, they should have a 2019 report or number that they can give you to include. For that state and local tax assessment, your CPA should be able to get that information for you very quickly. Now what's the maximum amount that we can apply for? And here I'm talking about that per compensation cap or per individual all-in cap. In the Act, I was very excited to see that when they identified the cap on payroll costs at $100,000, the only language that they honed in on was the term compensation. That would have been a great thing for us, particularly for our clients who have paired plans, where we might have done some pretty significant cash balance plan funding. Now, unfortunately, when we get over to the guidance side of this, that clarifying language really does identify in the fact sheet that payroll cost is capped at $100,000. In fact, they use that language twice. And in the application, excluding costs over $100,000 on an annualized basis for each employee. So it's my belief that that is actually going to be capped at $100,000 per individual all in on those different cost categories, which here we have an application example of. So you can see where we've got that all-in payroll number, that's from your payroll report, your safe harbor and your profit sharing, that's going to be from your allocation study. The cash balance paid number, I actually wanted to use an example where we overfunded the plan. So that's what you see down here in the bottom corner. In this instance, we had a cash balance plan. I said we have accrued about $106,000 in benefits. Then made sure that that was very top heavy for the owner and took that actual accrual percentage by individual, calculated that number out. Then we actually paid in, so that retirement benefits paid, we paid in for the year $175,000. So you use the accrual of benefits percentage and you multiply that by the amount that you actually paid in. And that's where we get that cash balance paid number. Now on the health insurance side of things, I use an example where we were utilizing a health reimbursement plan. Keeps it nice and easy, keeps it straightforward, but if you're paying health insurance for your individual employees, that would be the number you want to use there. And then we've got our state and local taxes. Bring that all together, get our all-in payroll cost. Then, who qualifies for the cap? In this example, I assume the doctor was going to be the only one that qualified for it, the owner. Now, if you've got associates in your practice, they may also hit that cap number. After we identify who hits the cap and we limit that at $100,000, then we've got our payroll costs. Bring that down, total it up, divide it by 12, get your monthly number, multiply it by 2.5, and let's get that loan amount. Now, we also have had a lot of action and pushing forward by the ADA recently in terms of the EIDL grant versus the PPP loan. So, one of the things that I want to clarify here, what we're actually seeing is that in the loan application, anything that we've got on an EIDL loan above the grant amount can be rolled into the PPP, and that would be very beneficial for a lot of reasons. However, it is not exclusionary. If you get an EIDL loan at some point after April 3rd, you can still accept that loan. Not going to have as good a terms as the PPP, which was one of the reasons we were excited about seeing that being able to be rolled into that PPP loan, but they are separate and apart from each other. What we are seeing though is that EIDL grant number. So if you applied for an EIDL loan and are in the process of receiving that $10,000 grant, as you can see in the language here from the application itself, that advance, now our terminology is still getting weird, that advance is actually the grant, is to be excluded anyways. So if you had an EIDL loan that came through prior to April 3rd, we can roll that into the PPP and take advantage of the fact that there are no prepayment penalties for the PPP loan, that there is a lower interest rate for the PPP loan than for an EIDL loan, and that there are subject to some of those forgiveness provisions. Now, those forgiveness provisions are likely going to be even under the amount that we're able to secure in our loan under the PPP. So that's probably a non-starter. That interest rate number though, that could have been a really helpful thing on an EIDL loan versus a PPP loan. PPP loan at 1%, EIDL loan at 2.75. And of course we always want to have our debt with no prepayment penalty and allow us an ability to control that and really design our cash flow around if we're debt adverse or not. So that EIDL loan, EIDL grant, PPP aspect of it, not as doomsday as it sounds. I do support the ADA in making sure that we've got all capital available to us and we are able to get that at the best terms possible. But I wanted to clarify that a little bit because of that EIDL loan provision in terms of our application for the PPP. If you did not move forward with a EIDL loan, SBA 7B2 loan that you did not receive the proceeds for prior to April 3rd, then that EIDL loan SBA B2 provision in getting your PPP loan amount is going to be zero. Even if you get the grant come through for $10,000, that is a non-recourse, non-payment grant. Hopefully that clarifies things. I know it's a complicated time and the rules are changing every day. We'll continue to keep you updated. Thank you so much for joining us.